Happy Friday. Welcome to our weekend edition of the Educated Homebuyer Live. This is where Josh and I give you a summary of what's happened this week, help guide you through all the craziness out there in the world of economics, our Trump, our president, Fed Chair Powell, all that good stuff. Josh, let's just dive into it, my man.
When you said our Trump, our president, I thought you were going to call him Daddy, like he got called at the
Dude,
European setup over there.
Like the song that he had out,
Yeah.
that I'm your daddy. But anyway, so listen, big news is Trump met with Powell yesterday. They took a tour of I guess the Fed building that had like a $2 billion renovation, something crazy. And he came away thinking that, hey, listen, Powell's a good guy. He's a good guy, and I'm pretty sure he's going to lower rates soon.
I like it because whenever I meet with someone that I need something from, I just walk away and assume that we're going to get what it is. It's manifesting things out into the world. So we'll see how it works. He did. I didn't find the exact quote I wanted to get it attributed, but someone I trust highly said that he said Powell is a good man. So we are gone from what is he, a loser? He's a very dumb man. He's driving us off a cliff, to now he's a good man. So I appreciate that we're all back on speaking terms and we're going in the same direction.
And he thinks that he's going to lower rates soon. So I'm not sure if that's going to translate into people actually putting real dollars behind their bets with regard to predictions. But we're going to have next week, we got a lot of data coming up. So this week, Josh, we've talked about not a lot happened on the data front, but next week we've got the Fed meeting, we've got PCE, we've got employment data. So it's a week packed full of information that could impact interest rates and just our lives. Our lives, Josh.
Our lives. This is our lives, Jeb. Mortgage, real estate.
That's really sad.
Our lives.
Oh, it's sad.
But we normally get one lame, boring week every month. The rest, you get CPI week, you get PCE week, you get jobs week. Well, this week we got a second bonus lame, boring week where nothing happened because PCE pushes into next week and we throw a Fed meeting on top of that. So next week, kind of a blockbuster, which will probably disappoint us. There won't be much come of it. But for this week, Jeb, really nothing big came out. We had the S&P manufacturing came out, fell to 49.5. Anything under 50 is contraction. But the more important part is it showed pricing pressures intensified across sectors, which is inflationary. According to all of the press conferences and releases that Peter Bookvar listens to, he takes very good notes on this stuff and examines the transcript. Said close to 65% of manufacturers and 40% of service firms cited tariff-related price increases in their latest earnings calls. Also pointed out that the new baseline U.S. tariff rate as of today is 15%. That's the highest in 100 years. So all of that keeps inflation elevated, above where the Fed wants it, above where you and I want it, above where you listeners want it. But it's definitely a little bit higher. We had some home sale info came out this week, Jeb. Existing home sales below expectations, 3.9 million. That's the lowest since 1995. So the lowest in 30 years. Very little activity going on. First-time buyers are only 30% of the market, largely because of affordability, high interest rates, high home prices. Inventory is up to 4.7 months of supply. That's the highest since 2015. And that is helping moderate price growth. So price growth was 2% year over year, but it's definitely over the last month or two slowed a bunch. New home sales were flat at 627, below expectations. Architecture billings, which kind of tells you going forward, more in the multifamily and apartment space, but they fell again to 46.8. Looking here at some of the big builders, both D.R. Horton and Pulte reported choppy buyer demand, increasing incentives, which we see. We hear that every week on the live show. People talking about the big incentives they're getting from the national builders and expected margin compression in Q3. One of the charts I saw, they're still like a 23% margin on a median sale price of $45,000 or $450,000. You're still looking at $90,000 of profit. They're doing okay.
And with that, Josh, I mean, more incentives happening, D.R. Horton coming out saying buyers are qualifying, but only with help from incentives. So we do know that, hey, listen, builders are in the business of making money, and they're not in the business of holding on to property. So they're doing what they need to do in order to incentivize buyers to come in. I mean, in fact, we had a couple people on the live show this past week saying, hey, builders are doing 3-2-1 buy down, some different things. In fact, this last week on our actual podcast, which you can catch on Spotify or Apple, here on YouTube as well, talked about the permanent versus temporary buy downs, thoughts on it, pros, cons. It's not a one size fits all scenario. So just make sure you understand it before you just dive into it, and understand where that money's going, because essentially it's just your money. So there's ways to get incentives in other ways that could actually benefit you long term versus the shorter term of a buy down. But Josh, what else do we got?
Not a whole heck of a lot. Like I said, it was a slow week. From earnings calls, Capital One, American Express, and Key Corp all said variations on consumers in good shape, not great, but good shape, stable employment, rising real wages, meaning wages are going up at a rate higher than the rate of inflation, and lower delinquency trends. On the downside, Chipotle and Domino's reported that lower income households and discretionary spending are softening. But what does it actually mean for us over the last week? Not a whole heck of a lot. Rates are flat. According to Mortgage News Daily, 30-year fixed at 6.81 as of today, which is exactly flat week over week. FHA and VA 6.375, a little bit higher than that. They're reporting also flat week over week. So from that perspective, it truly was a flat week. I don't have the bond chart here to pull up and share with you guys, but we ended last week at 444 on the 10-year, 442 on the 10-year. And if we were to close right now, we'd be at 440. So down 2 basis points. At the best levels of the week, it was down 10 basis points. That's a very, very narrow range. That's way less than an 1/8% in interest rates. So if you're out in the market, nothing changed over the last week in terms of mortgage rates and what you're going to see next week. And again, that's to be expected, Jeb. We had a very boring week, not a lot of economic data. The proverbial stuff hits the fan starting Tuesday with PCE.
Yeah, and I think we should talk about whether or not you should lock prior to some of this data. But let's end the episode there today on the live. But let's talk about one of the things that's really held steady, Josh, and one of the reasons that the Fed hasn't pivoted, and that's jobless claims continue to, I don't want to say outperform, but they're low, relatively speaking, to what we would need to see in order to see the Fed actually have some cause for concern. I think we came in this week at 217, which is a little bit higher than expected. I think we were like 214 or 2 something, like low
217. And the continuing claims is probably the important part, Jeb, at 1.96 million, almost 2 million. Definitely
so elevated there. So we still got Waller pushing for a Fed rate cut. But at the end of the day, the Fed chart, as we showed on Wednesday, hasn't varied much. I mean, it looks at this point, best case is probably September, for a Fed cut, because we have July, which comes out next, Thursday. Thursday is the 30th.
The Wednesday will be the Fed announcement.
Oh yeah. Wednesday is the Fed announcement. And then you have August off. For the Fed doesn't meet in August, and they're back in September. And last September is when the Fed dropped 50 basis points, and we actually saw rates went up. So we actually have a question here in the chat from Rakesh. Says, what's up, fellas? Even if Powell cuts rates, there's no guarantee that mortgage rates will go down. His 1% last year, and we're still in the 6 to 7% range. Too much bond uncertainty. So I think, Josh, we've talked about it so many times. Transparency. The Fed has already said, hey, there's a chance 2 to 3 cuts this year. They've laid it out there. If they follow through, get 2 to 3 cuts this year, and that's essentially what the market agrees on, probably very little activity going to happen on that rate front, because, again, the bond market moves before a lot of this stuff with announcements and that sort of thing. So we've been in this narrow trading range on the 10-year from 410 to 450, probably for the better part of this year. And interest rates are essentially in the same ballpark. I think the lows we've seen is probably 6.5, upwards of 7%, somewhere in that ballpark.
It's important to know, Jeb, that Rakesh is correct. So we saw a big move downwards in bonds ahead of the Fed cuts in the fall, and the Fed cuts 100 basis points and rates went up. That historically is an anomaly. If it happens again, if we get another cutting cycle and it goes up, then we will not say it's an anomaly. We'll say it's just an interesting change. I wouldn't expect it to happen again going forward, because generally, Jeb, the Fed is looking at the same thing markets are. So when they were making those cuts, they knew they were restrictive. What happened last fall is that we had some hotter inflation readings coming out, and the markets got spooked that the Fed was cutting at the wrong time. I think they're a little bit more in sync now. But as you said, the Fed cuts are generally precipitated by market moves. The market doesn't, the Wayne Gretzky quote, the market is actually skating to where the puck is going, not where the puck is. And in that sense, where the Fed funds rate is where where the puck is. So I wouldn't worry about that being the new trend going forward, that mortgage rates are unhinged or treasury yields are unhinged from Fed action. But it was definitely an interesting paradoxical anomaly last fall.
And then Skip comes in here and says, isn't the best Fed update the 30th? I'm not sure what that means, but the Fed does come out and announce. So they'll meet on Tuesday. They'll announce on Wednesday. And essentially the market at this point is pricing in that rates stay the same, that there is no change in interest rates. But the important part of that meeting, even if they don't change rates, is the press conference afterwards, where they get to ask questions and Fed Chair Powell makes statements. And that's what's really analyzed in this whole thing. And that's where you get volatility in the market. And Josh, did we determine if we're actually going to get ADP on Wednesday morning, or is it going to be the following week?
Let me get back over
because we're going to get PCE on Tuesday. PCE is important because that's the Fed's preferred measure.
We do get it on Wednesday, so okay. I don't. They're just going to front run it. Maybe they just run a 4 week. I don't know what they're doing, but yeah, we will get it on Wednesday.
Okay, so the Fed's preferred measure of inflation's on Tuesday. The idea here is that some of the inflation from tariffs could show up in this PCE data. If for whatever reason we show some sort of big reduction in PCE and inflation getting closer to 2%, I guess there's a possibility that the Fed pivots and does a Fed rate cut. But I think the market expectation is that, hey, listen, PCE, these are the numbers coming in on PCE. It's already built into what the Fed's likely to factor into their conversation, their conference, and probably no rate cut.
What I will say, Jeb, the Cleveland Fed inflation nowcast has been pretty darn accurate. They are projecting 0.24 for month over month on core PCE and 0.21 on core. And I believe we have low numbers dropping off. So the year over year is going to be about the same, about flat to where we're at. And the way they do that with the rounding, we would have to have a big beat. That 0.24 would round to 0.20 in the headline numbers that you're going to see. So we would have to get to 0.14. We'd have to be on a full 1/10 miss. And with all the uncertainty and everything going on with the tariffs, pretty unlikely. But I don't think you're going to get an upside surprise either. So, Jeb, we were talking about the Fed meeting and the press conference being important, how Powell reacts and answers the questions that are thrown at him. A couple weeks after that, we'll get the minutes from the meeting. This is one of the interim meetings. 4 times a year, we get their summary of economic projections or their dot plots. Not that they're very accurate, but is a good insight into seeing what the Fed is thinking right now. We'll at least in another couple of weeks get the minutes from this meeting, where at least the parts that they want to share with us in terms of the debate and discussion among the group of what comes next.
Yeah, Powell's always like super calm, collect. He says the right things in the meeting. He doesn't ever feel like he's like, shaken or whatever. I hope this time he comes out and he's like pissed, like he's like tired of having the same things, and he just gets angry and just throws the market into like some sort of turmoil.
Those type of people don't get elected to.
Yeah, you're right. Yeah, they do, Josh. They very well. They might be our president in some regard. But let's answer the question that we asked earlier. If you are in contract right now, maybe shopping for a home this weekend, are you locking your interest rate ahead of this data-packed week next week?
If you are in escrow, you probably should be looking at locking, not because I think there's a sea change coming. We've kind of seen that 460, 462 on the 10-year as the high end, which is about 20 basis points higher, or a quarter higher in interest rate. And below us, we've been about an eighth, maybe as much as a quarter lower than where we're at. So we're kind of in the middle of the range, and we have a lot of data coming. So unless you are really, really risk tolerant, it could go either way. It could get better, it could get worse. I have people that they just can't stand the idea of leaving one nickel on the table. So exposing themselves to some risk to potentially get it is worth it to them. Most people, buying a home is a stressful enough situation. They prefer to lock and stay out of the way of this much data. With PCE, we pretty much know it's going to be flat month over month. Not a whole lot should come in there. With the Fed meeting, we just talked about it. Not going to do anything, probably not going to answer anything crazy at the press conference. You got ADP, you got NFP on Friday. Unless NFP is a big positive surprise, meaning lots of people losing their job, I don't think we're going to move significantly lower. There could be an upside surprise in any of that data that would take rates to the high end of that range, which could be as much as 0.25% higher than where we're at now.
All right, and the last thing I would add is we shot an episode yesterday talking about the Vantage score, the possible change. Well, it's going to happen. Vantage score is going to come in as an alternate to FICO. And it's going to allow, I think the numbers was like 35 million more people with the possibility of being able to buy a home. Doesn't mean they're all going to do it, but gives them the option because they're now going to have a credit scores that they didn't have otherwise.
35 million more will have scores. 25% will have scores that will make them mortgage eligible. So about 9 million.
Yeah, 9 million people. So with that said, if you're interested in how Vantage Score might impact your home buying process, check out that episode that we're going to drop on Monday. And if Josh can be any of assistance to the pre-approval process, you have questions, you need a second quote, use that link scrolled in the bottom of the episode there. It'll get you in touch with Josh and the team. He can walk you through that process, go through the pre-approval, guide you. And if I can, help you find a pre-vetted real estate agent that does business like I can, that same link will get you in touch with me. With that said, Josh, any final words before we head out today? What's the advice for people shopping over the weekend?
We had a peaceful, boring week. Enjoy the weekend. If you're out looking at homes, you need help, reach out. If you want a second opinion on anything, reach out. Just know we have seen a change. Buyers have a lot more control, seeing a lot more incentives, some of them big incentives, some of them small incentives. Sellers, especially during escrow when things come up during inspections, being pretty amenable. So it is a good, normal market where there's some give and take, where you don't feel like you are giving up everything as a buyer. So if you're out shopping, hopefully you find what you're looking for this weekend.
All right. Be smart, be wise. Till next week. Adios.
Amigos.
Peace.